Hello and welcome. You're watching ET Markets. I'm Tanya Aneja and I have with me a very special guest today. We have with us Abhay Agarwal, founder and fund manager, Piper Serica. Thank you so much, Mr. Agarwal, for joining us on ET Markets today.
Thank you, Tanya. That's my pleasure.
So let me begin by asking you about the current scenario that we are seeing in the markets. So basically, it's a tug of war that is happening between bulls and bears. So how are you approaching markets at this point in time?
Yeah, I think you actually used a very, very good analogy, of a tug of war between bulls and bears. Because what we are seeing now is that after a sharp correction from January, not only in Indian markets but global markets, what we are seeing now is that while the market is trying to find a bottom, and it seems to be getting close to a bottom, at the same time, it is not able to get into a V-shaped recovery zone also, because any slight rise is still getting sold into. But at the same time, what is happening is that it seems to have stopped falling, which was a concern in most of the May and early part of May, that every day, you will come in and there would be a sell-off closer to end of day. So I think the good thing is that we're not seeing that, and one of the reasons for that is the market is clearly oversold. Technically, also the positions are very light, and we saw FPIs also, while they are still net cash sellers, still building long positions in the derivative segment, and globally also we have seen some recovery. So I think this last bit of battle, tug of war, will continue maybe for another couple of weeks. But I think clearly the volatility will reduce going forward. I think the worst of the volatile period is at least behind us.
Oh, absolutely. Good to hear that. And let's talk about the GDP numbers as well. So the GDP has grown by 8.7% for FY22 and 4.1% for Q4 FY22. So of course, the growth we are looking at is because of the low base effect. So how are you looking at these numbers?
Empirically, if you look at it, and we do a lot of channel checks where we engage with distributors, retailers, also the supply chain of a lot of large industries like autos and paint and tiles and plywood. And in last quarter Q4, the feedback that we were getting was there is robust demand. So and while the prices were rising, still there was consumer demand because coming from COVID lows. And that has continued in the current quarter also. Okay. So that gives me the confidence to say that, look, the GDP growth numbers will probably continue to surprise on the upside because there is very, very robust consumer demand across the board. I mean, if you look at discretionary also, the numbers we are seeing in autos, the numbers we are seeing in real estate and some of the large sectors are quite robust. The good thing is that the inflation hasn't seemed to impacted volume growth. People are still consuming. The salaries are going up. People have money to spend. The rural economy is doing pretty well because of the higher food inflation. So I think overall, I would estimate that if we ignore the high base effect, low base effect, and because of this the GDP growth rate number was higher. But I would expect this 4% to 6% number to continue for this quarter and the next quarter also.
So talking about the auto sector only, companies posted strong sales in the month of May. So we have also seen a bit of a pullback in some of the auto names. So do you see more upside going forward?
If you look at the auto segment, it is now getting pretty sharply divided into different categories. So if you break down the categories, the two-wheeler segment seems to be struggling. First, there was a lot of electric vehicle demand pressure where people were choosing to go with EVs rather than traditional two-wheelers. And then also what we are seeing is that because of higher rural incomes, there is a switch happening at the rural level from two-wheelers to four-wheelers. And that is one of the reasons that passenger vehicle segment continues to do well. And some of the industrial products like even or agri products like tractors continues to do well. So our estimate is that there will continue to be demand pressure on two-wheeler segment. We're not going to see a sharp growth uptick there. But in passenger vehicles, there is definitely latent demand, and while the cost has gone up for passenger vehicle manufacturers because of various safety standards that the government has introduced, plus higher insurance cost, input cost, but they are able to pass on, and Tata Motors numbers, if you see, it's a classic example that if you continue to innovate, continue to launch new products, you will find buyers. I think if anybody looks at auto sector, they will have to look at each segment separately and not look at one whole segment.
Right. So, and what are your thoughts on the March quarter and full year earnings season? Have you spotted any themes, especially after the recent correction and after the numbers?
One theme that we could clearly see is that the customers are willing to pay, for products that are or services that are unique, new. There is no shortage of demand. At the same time, companies that have not innovated during the COVID period, have not invested, have vacated the market, they are struggling. The second thing that we see that the bigger companies with better balance sheet have come out better with higher market share compared to some of the weaker competitors who do not have the balance sheet strength to support the supply chains and the distribution chains. So if you look at the large FMCG players, Lever, Nestle, ITC, they have the financial muscle to support their stakeholders during the downturn, and as a result, they have come out with higher market share, though the margins are suppressed. The third thing that we have seen is that margins are, while there is top line growth, the margins are getting compensated because the companies do not have the confidence yet to pass on the entire cost price inflation to customers. So they are asking the channel partners, distributors to absorb some of it partly, and they are absorbing it partly. The hope is that the prices will reduce, the cost prices will reduce, so the margins will go back to normal. So I think overall, I would say that the results have been slightly better than expected, but largely in line with what we were also anticipating. The fourth last point I would like to see is that, which is very heartening, is that the balance sheets overall have become better. So the overall leverage in the corporate sector has gone down. There are no hotspots, no companies that are going to go bankrupt. Banks' balance sheets are also overall better.
Absolutely. And what about the metal pack? There's this significant correction that we have seen so far. Your thoughts on the same?
Metal space, is a victim of all governments trying to protect their local industry and fighting inflation. And the way the metal prices, commodity prices had escalated, all the commodity metal users were complaining to the government. The real estate players were complaining, the auto sector was complaining, saying that, look, these are just very high prices, and a lot of it is because of tax structures not being efficient. So the government has heard them, and as a result, taken away any potential for windfall profits. And I think the government is going to be very cautious that, look, one sector or one metal sector should not make extraordinary profits at the cost of rest of the economy. So I think the metal sector will continue to see this pressure because the government's clear view, and we've seen that through RBI policy action also, the message is very clear. We do not want the inflation to go out of control, and metals are a key part of that. So I think the government is going to do whatever it can to keep metal prices under check. And the result of that is getting reflected in metal stocks, clearly. So I don't think that's going to let up in a hurry.
Okay. And going forward, we are also expecting more aggressive rate hikes from RBI.
Yes.
So how do we see it for the financial sector and banks?
So I think RBI's has completely flipped this position from saying that growth at any cost to now saying low inflation or inflation fighting at any cost. So now clearly in the next MPC, there is an expectation that there will be a rate hike. It's more or less given based on what the governor said in his last interaction. But beyond that, it is still difficult to say, because if the commodity prices come under control, if WPI falls, even if CPI stays high, but WPI starts falling, then the RBI can go back to a neutral stance also, in the, not in the June, this month, but in the next month MPC. So we'll have to wait and watch. I don't think investors should make a call right now that interest rates are only going to go up. They may stay flat, high flat level also. I think as the cost price inflation comes under control, which hopefully it would, as supply chains improve, the rate hikes may not be as sharp as some parts of the market are expecting them to be.
Okay, let's hope for the best. And also not to forget the new age internet companies. I mean, the shares like Paytm, Zomato, Nykaa, they have corrected significantly, right? So do you think this is the right time to step in now?
What happens, when the market corrects sharply, even good companies and companies which have, not the best business models, everybody gets sold. And that gives astute investors an opportunity to do their hard work through research and figure out if entire consumer internet industry has got sold, which are the pockets there is still value. And for me, the value is in companies that have a clear path to profitability in their business models. And they do not only have that path to profitability, but they're able to articulate it also clearly to investors. They make that extra effort, and they are able to show that through performance. So there are a couple of companies like Paytm, if you take an example. Our worry continues to be that the path to profitability is very long, and there are a lot of out of control events on the way. Whereas there are companies that are already profitable, like Nykaa. Then there are some companies which have a clear path to profitability, like Zomato. Then there are other companies like Paytm still struggling to be profitable, like Policy Bazaar or some of the other companies. So I think there is definitely an opportunity if somebody takes a long-term view, 5-year view, 8-year view. They will be winners, big winners that will emerge from this pack. But investors will need to do their work and figure out which are the companies which will become very profitable as they scale up, compared to companies which still do not have a well-defined business plan.
Okay. And also, foreign investors have been on a selling spree. I mean, May was in fact one of the worst months in terms of foreign equity outflows from India. So do you think that the worst is over for us, or do you see further outflows from India?
Well, frankly, we thought that in April itself, we were close to peak selling, because what we were tracking were the global, the cash holdings of global funds. And from a normal 3%, the cash holdings went up to 4%, 4.5%. They crossed 5%, I think, in February. And in March, April, they were 6% plus. And that kind of high cash holdings we had seen only during the 2008 financial crisis. So even during COVID, the cash holdings didn't go up to this level. But surprisingly, in March, the selling continued and continued not only in India, across the board. And now the cash holding of global funds is well over 6%. So there is, and also if you saw the latter part of May, especially the last week, the selling slowed down. It was still negative, but not as negative as it was in the first half of May. So there is a hope that while flows may not reverse in a big way immediately, that the worst of the selling is behind us, and slowly and steadily global investors will look for investment opportunities in stocks that they like, that they have got beaten down, and will come back. So I'm keeping my fingers crossed. I am hoping that in a worst case, June turns out to be a neutral month where we don't see a negative number, and then hopefully from there on, as prices cool off, we will see some inflows in the next month.
Absolutely. We hope the same. And last but not the least, Mr. Agarwal, high inflation continues to be the biggest concern amid the global slowdown, rising interest rate, and weak consumer sentiment. So it's a tough market right now, right? So what would be your advice to all the young and new investors at this point in time?
So I've been investing for 28 years, and if I take the learnings of this period and say, look, I know everything, and now I go back 20 years, I would not get swayed or not make investment decisions made on very near-term events. So because a lot of times things auto-correct in the market. If there are phases of high inflation, but they correct also as supply chains come on and demand and supply equalizes. But at the same time, when there is a period of highest uncertainty, you get the best investment opportunities. And that is one learning that I would like my younger peers to take, that look, do not get too worried about the near term events. There's a war, there is high inflation, there are a lot of problems that we see, but the job is to still be able to find long term investment opportunities. And this is the best time when there is still uncertainty. When there is certainty, that is the time when you have highest valuation and you struggle to make money. So I would say that this is the time to do your research, figure out companies' business models, and definitely continue to stay invested. Do not tweak your allocations too much. If you have a certain allocation plan, stick to it. Markets always go through volatile phases, but long-term investors should not, worry too much about what happens in 1 month or 2 months or 6 months.
Thank you so much, Mr. Agarwal, once again for taking your time out and talking with us today. Thank you so much.
Thank you, Tanya. It's been my pleasure. Thank you.